So, welcome to Jumbo IS and welcome to our lecture series on GS economics. Our today's topic of discussion is fiscal policy. And fiscal policy is nothing but policy of the government. Government's policy with respect to the economy is called fiscal policy. Now, up till now, whatever we have discussed in the economics portion, up till now, whatever things we talked about, we learnt about, well, all those things could have been managed without the government. Okay, banks can be managed without the government. RBI is independent of the government. Okay, many private corporations are independent of the government. So, all these things that we have discussed so far, well, they could have been managed without government. But in real life, government is not absent. Okay, government is very much present, right? And government plays a huge role in influencing the economy. Now, government influences the economy through its fiscal policy. Every year, when the government comes out with the budget, well, budget is nothing but a document of fiscal policy. That is why some people call government budget as fiscal policy document. Okay, so today we are going to talk about the huge role that government plays in influencing the economy. RBI plays a huge role in influencing the economy through its monetary policy. Government also plays a huge role in influencing the economy through its fiscal policy. Okay, so today's topic of discussion would be fiscal policy. All right, so let's start today's discussion with fiscal policy, chapter number 7. This chapter is also going to take a few parts. Therefore, today we are going to be discussing part 1. But before we start the discussion, first let's talk about what all is there in fiscal policy, the chapter of fiscal policy. So in this chapter, we will discuss concept of fiscal policy. This is very important. You need to understand what fiscal policy is. Then we'll talk about goals of fiscal policy. Okay. Then we'll talk about government budget. Then certain important terms which are very important. Okay. Various deficits and other important terms. Then we are going to talk about Fiscal Responsibility and Budgetary Management Act. And in the end, we'll talk about a concept called Ricardian equivalence theory. Very fascinating concept, okay? So we'll be talking about these 6 topics, subtopics in the mega topic of fiscal policy. So let's start today's discussion with subtopic number 1, which is concept of fiscal policy. Now, do you guys remember what was the formula of GDP? You remember GDP was C plus I plus G plus X minus M. You remember that? Where C stands for private consumption, I stands for private investment, G stands for government expenditure, X for exports, and M for imports. Do you guys remember? Do you guys also remember when we discussed this formula, I told you that this formula is going to come again and again in our lecture series, right? Well, today is the day where this formula is going to feature. So our GDP is basically driven by these 4 drivers: consumption, investment, government expenditure, and net exports. Fiscal policy is all about government. Okay, so GDP is influenced by government, right? And government influences this GDP, or this G is basically determined by fiscal policy. Okay, now let me give you an example how government influences economy. Okay, well, government levies taxes. Okay, and the more taxes that the government levies, if government increases taxes tomorrow, well, what would happen? People would have less money to spend. People would have less money to spend, so their aggregate demand would also decline. And when aggregate demand falls, well, GDP will also fall, right? So government can reduce economic output by reducing aggregate demand by increasing taxes. So taxes play a huge role in impacting aggregate demand. Plus, government also spends on various goods and services. Government buys certain goods and services. Government makes sure that certain goods and services are available to the people. Government spends a lot. Government also spends on infrastructure projects, right? Roads, bridges, and all of that. Clear? Now, this spending by government increases government expenditure over here. And as we can see clearly from the formula, government expenditure over here, if it increases, well, it increases the GDP. Make sense? So through its policy of taxation, through its policy of spending, government influences the economy in a big way. And this entire policy of taxation and government spending is nothing but fiscal policy. It works in tandem with monetary policy. Monetary policy does its job. Okay, it can increase economic growth, it can decrease economic growth. Similarly, fiscal policy also does its job. It can increase economic growth if government increases spending. It can decrease economic growth if government increases taxes. Right? So fiscal policy is government's policy of taxation and spending. Nothing but taxation and spending. Okay? Make sense? And this policy is outlined by the government every year in its budget document. Okay? That is why I told you in the beginning that fiscal policy is nothing but, or government budget is nothing but fiscal policy document. All right? So here are a few things about fiscal policy. Let's read a few things. Fiscal policy is the means by which government adjusts its spending level and tax rates to monitor and influence a nation's economy. Okay. Now, fiscal policy works in tandem with monetary policy. As you all know, that monetary policy, which is determined by RBI, monetary policy can boost economic growth. If RBI decides to increase money supply, that would boost economic growth. Monetary policy can impact inflation. If RBI decides to reduce money supply, then it reduces inflation also. Similarly, fiscal policy also can impact growth, can impact inflation. That is why sometimes it is also referred to as the sister strategy of monetary policy. Both these policies work together. If they work in sync, if RBI and government are in sync, okay, sync means they are synchronized, then it benefits the nation. If they are opposite in nature, well, then it harms the nation. Any which way, we'll talk about that later. But it's a sister strategy of monetary policy. These two policies, monetary policy and fiscal policy, are used in various combinations to direct countries' economic goals. Every year, government announces its fiscal policy through the budget. We have discussed that. Clear? So fiscal policy is nothing but a policy of government's receipts, the money that government receives, and government spending, expenditure. And this is nothing but government budget. All right? And we have discussed this, that G over here is a very important driver of GDP, and G is nothing but fiscal policy. All right? Okay. Now we'll talk about goals of fiscal policy. What are the goals of fiscal policy? Why does government come out with a fiscal policy? Why does government come out with a budget? Right? So, there are three major goals of fiscal policy. Clear? Goal number one is allocation of public goods. Now, to understand this goal, you need to know what public goods are. Okay? So basically, there are two types of goods: public goods and private goods. Now, what's the difference between the two? Well, the thing is, some of you might be thinking that private goods are those goods that are produced by private people, and public goods are those goods that are produced by government. That's the simple difference between the two. Well, not exactly. That's not the difference between the two. In fact, government also produces private goods many a times. Clear? There are other differences between the two: public goods and private goods. Okay. Public goods have two features which private goods don't have. Okay. Feature number one is public goods are non-exclusionary. What do you mean by non-exclusionary? Well, they do not exclude anyone. These goods are available to all, everyone. Okay, everyone who's a citizen of India, well, these goods are available to all these people. Whereas in case of private goods, well, they are not available to everyone. Those who can afford their price can avail those goods. Those who cannot afford their price, they cannot avail these goods. Okay. Private goods are exclusionary, public goods are non-exclusionary. I'll explain this with an example. Okay, roads. Okay, public roads. Now these roads are available to all. Anyone can travel on it. Any citizen of India can travel on it. No one is excluded. No one is excluded from using that public road. So public road is what? Is a public good. Okay. Whereas this pen is a private good because it is exclusionary. This pen costs, let's suppose, this pen costs 100 rupees. So those people who can afford 100 rupees, well, they can get this good. Those people who cannot afford this 100 rupees, well, they won't be able to access this pen. So this pen is exclusionary. iPhones are exclusionary. Okay, everything that is available at a price is exclusionary, basically. Okay, but public goods are non-exclusionary. There are many examples of private goods. Everything that is available for a price is exclusionary and is a private good. Now you understand when I said that even government manufactures private goods. Government companies also manufacture coal, steel, and many other things, and they are available at a price. So their government is manufacturing private goods. There is a government company called ONGC. It manufactures petrol diesel, creates petrol diesel. They are available at a price. Those are private goods. But government also creates public goods. Okay, public roads, public parks, and many other things which are non-exclusionary. So this is feature number 1 of public goods. Feature number 2, which you have to remember, public goods are non-rivalrous. Okay, non-rivalrous means that if one person uses that good or takes that good, he does not leave less for other people. Okay, non-rivalrous means that if there is a good and if one person uses that good or takes a lot of that good, then government will make sure that enough is left for other people. Whereas this is not true for private goods. How? Let's suppose the entire country of India manufactures 100 pens and I buy 70 pens. Now there are only 30 pens left. So I have left less amount of pens behind for everyone else. This pen follows a rivalrous relationship. But when it comes to public goods and services, well, they are non-rivalrous. If someone uses excess of a good, well, government will make sure that enough is available for everyone. Clear? Now, public goods has many examples. Public goods, there are many examples of public goods and services. By the way, when I say goods, I mean goods and services, both. Okay, so what are public goods? Well, public roads, parks. Okay, then there are public services also. Law and order service. Law and order service is a service provided by the government and it is available to all. Police is available to all. It is not exclusionary. Those who can pay for police will get the police services. That is not true. Okay, and it is non-rivalrous. That's not the case that if someone else uses too many police services, then it is, less is left for others, right? Law and order service. Then government also provides us with national defense service by our armed forces personnel, right? These are examples of public services. And roads, bridges, railway tracks, all these are examples of public goods. There are other examples of public goods also. Government created UPI. It is a software, okay? But this UPI basically is available for all. Everyone uses it, right? So this is an example of public good, public infrastructure basically. Make sense? So these are public goods. Okay, be careful with this definition. Always remember, if you are asked this in your exam, what is a public good and what is not a public good. Let's suppose there is a MCQ which says which of the following is not a public good. Then apply these two principles. Those goods which are non-exclusionary, non-rivalrous. And most of the times, if you only apply non-exclusionary, you will get an answer. Okay. Now, what is the job of fiscal policy? Look, government wants that some goods should be available to all. Okay, like road facility should be available to all, bridges facility, UPI facility, and many other facilities, they should be available to all, right? That is why government spends on creating these goods and providing them to the general public. Okay, that spending of the government is utilized to allocate public goods to the general public. Okay, so allocation of public goods is one goal of fiscal policy, which every year comes out, the government comes out in its, which every year the government allocates or talks about in budget. Okay, so in budget, government would give you an idea how much it is spending on roads, bridges, UPI, or it is creating any other digital software, DigiLocker, all these examples, Aadhaar database, all these are examples of public goods. Clear? So number one aim of fiscal policy is allocation of public goods. Very simple. And now you know what public goods are. Clear? Very simple. In case there is any doubt, please do ask me. Okay. Now we'll talk about function number 2 or goal number 2. Redistribution of national income. This is another important goal of fiscal policy. You see, there are many rich people in India, extremely rich people in India. There are many poor people in India, extremely poor people. Okay. Now the thing is, government runs various welfare schemes for these poor people. But where does this money for welfare comes from? Well, government levies taxes on the rich people. Okay, this money is allocated towards welfare, and this welfare money is spent on poor people. So in a way, government is playing Robin Hood in this case. Government is taxing the rich, taking money from them, and giving it to the poor through welfare schemes. Right? This is what government does. Now, every year in the budget, government gives out its taxation policy. Okay, and government also says that through our taxes, we'll collect this much amount and then we'll use this much amount to spend on welfare. Right? Now, government taxes the rich, gives the money to the poor. In a way, don't you think government is redistributing income, taking from the rich and giving it to the poor? Government is redistributing national income, right? And this redistribution of national income happens through fiscal policy. Because what is fiscal policy? Policy of government taxation and spending, right? So redistribution of national income is another goal of fiscal policy. Very simple. Make sense? Okay. Now we'll come to the third and the most important and a little technical goal of fiscal policy. Please pay close attention because this part is a little technical. Allocation of public goods, redistribution of national income was all very easy. Okay. As long as you know the definition of public goods, goal number 1 was easy to understand. Goal number 2 is as it is very easy to understand. But goal number 3 is a little technical. So please give me your 100%. And after you understand this, you'll understand the role played by the government to influence the economy in a new light. You'll understand why government is doing what government is doing. Okay. So we'll talk about goal number 3, and that is stabilization of the economy by counter-cyclical measures. This picture over here is that of John Maynard Keynes. And we have talked about him. Okay, we have talked about him. I made a cursory reference in the topic of national income accounting to John Maynard Keynes. But John Maynard Keynes played a pivotal role. Basically, John Maynard Keynes is also known as the father of macroeconomics. Before John Maynard Keynes, economics was microeconomics only. But it is because of the interventions made by John Maynard Keynes that we created a separate subject within economics, separate branch of economics that is called macroeconomics. And within macroeconomics, government plays a huge role. And government plays that role through fiscal policy. Now, what is that huge role that John Maynard Keynes talked about? Okay, John Maynard Keynes talked about counter-cyclical measures. Okay, and John Maynard Keynes said that these counter-cyclical measures actually stabilize the economy. Because if there is no government, economy can be destabilized very easily. The main role of the government, apart from allocating public goods and redistributing national income, is stabilizing the economy if it encounters any hiccups. Okay, and government stabilizes the economy. John Maynard Keynes says that government stabilizes the economy through counter cyclical measures. Okay, so I said that this third goal is the most important and a little bit technical. So we are going to spend some time on this third goal. Okay, first of all, let's understand what is this counter cyclical thing that John Maynard Keynes is talking about. And then we'll try to understand how this counter cyclical thing stabilizes the economy. Okay, so first let's talk about counter cyclical measures. Okay, very simple to understand. You see, our economy, okay, sometimes our economy or any other economy sometimes goes through phase of boom when the economy is rising, goes through a phase of slowdown, and sometimes goes through a phase of recession. Okay, then it rises again, then it slows down again, then it rises again, and then it slows down again. Okay, every economy goes through these cycles. No economy can permanently rise, no economy can permanently fall. These are economic cycles, sometimes also referred to as business cycles, because economic cycles are derived from business cycles. This concept of business cycle was used in microeconomics. When you extend it to the entire economy, we call it economic cycles. Okay, so boom at the crest and recession at the trough. These are economic cycles. Clear? Make sense? Now let's suppose our economy is going through a phase of recession. Okay, when our economy is going through a phase of recession, there is no money in the economy. No one has any money in the economy. Okay, businesses are running losses, and when businesses are running losses, they don't have money, people don't have money. Well, there is general shortage of money when there is recession. At that moment, generally what happens is that because there is no money in the economy, government's tax revenue declines. Government also has no money because there is no economic activity, so there would be no GST. People's incomes are falling, so income tax would also fall. So there is shortage of money with the government as well. Government's tax revenue is declining, but government has spending obligations. Okay, now if government won't have any money, then how would government finance its spending? So generally what used to happen was that during a recession, government used to raise taxes. Okay, because it had no money, tax revenue was not enough, so government increased income tax rates, GST rates, so as to get some money. Okay, and government used to reduce its expenditure. Clear? Now there are two types of government expenditures, by the way. Let me tell you, one type of government expenditure is committed expenditure. This is something that the government has to spend. Okay, for example, salaries to the employees, salaries to the armed force personnel, law and order expenditure, public service expenditure. All of this is government's committed expenditure. This expenditure government has to incur. Then there is some expenditure of the government which is non-committed in nature. Okay, like subsidies, welfare schemes, all these things government can reduce also, right? Now, the thing is that tax revenue has declined so much that government even cannot finance its committed expenditure. So what does the government do? Government raises taxes on the people so as to get some money. And government reduces its non-committed expenditure, sometimes even committed also, but government reduces its non-committed expenditure, government reduces subsidies, welfare payments, and everything. Whenever there is a recession, the natural tendency of the government is to do these things. Now, these things are counterproductive. These things would further worsen the recession. How? Already people don't have any money. If you'll raise taxes on them, they will further have no money at all. How would they spend it on the economy? Right? If people have no money, aggregate demand has fallen. If you have increased taxes on that, then they would literally have no money and they would not buy any goods and services from the market. Aggregate demand would fall considerably. Aggregate demand would fall considerably because you have raised taxes. Clear? Recession would deepen. Yes. Plus, when you have reduced your expenditure, what was GDP? C plus I plus G plus X minus M. This is a recession going on. Already C is down because you have raised taxes. Investment is down because people have no money. So private corporates are also not investing. Why would a private corporation open another factory when it knows its goods and services are not being sold in the market because people have no money? So I won't open another factory. And what was that another factory? Plant and machinery. What was that another factory? Capital good. So private investment has also fallen. And now if government also reduces expenditure, then government expenditure would also fall. GDP would further fall. Recession would further deepen. Okay. Now, the natural tendency of the government is to do these things. Whenever there is a recession, government does what? Increases taxes, reduces spending so as to save itself. This policy of the government is known as pro-cyclical policy. And John Maynard Keynes says that this is the worst decision that you can take. This is the worst decision that you can take during a recession. Okay? John Maynard Keynes says that if a government follows pro-cyclical policy, which was this one, increase taxes and reduce spending during recession, recession would further deepen. What should the government do? Well, government should reduce taxes. Because if government will reduce taxes, what will happen? Okay, people will have some respite. They will have some money left. They'll use that money to spend in the market to buy goods and services. More goods and services would be bought and sold. GDP would come up slowly. Yes. So government should reduce taxes. And the other thing is that government should increase its spending. Increase its spending manifold. Because if government does that, then government expenditure would increase. So even if consumption expenditure is down, investment expenditure is down, import export is down, at least you can save the GDP by this one G alone, government expenditure alone. And government would slowly, or economy would come slowly and gradually out of recession. Okay. Now this policy of reducing taxes and increasing spending during a recession is nothing but counter-cyclical. And this counter-cyclical policy basically saves the economy from a recession. So whenever there is a recession, you somehow do the opposite of your natural tendency. That is why it is known as counter-cyclical, opposite to the economic cycle. Clear? Now I know what you might be thinking. Okay? You guys must be thinking that already government was short of money. Okay? You are saying that government should reduce its taxes further and increase its spending more. Okay? Let's suppose government was earlier earning 100 rupees from taxes and spending 100 rupees. Okay? But now if government follows counter-cyclical policy, then government should reduce its taxes, it should drop to 50, and government should increase its spending, it should drop to 200. Okay? So government was already short of money. Now you're saying increase your expenditure, right? And reduce your revenue. Where will this shortfall of 150 rupees come from? Where will this shortfall? Where will this extra 150 come from? Well, this extra 150 will come from borrowing. Government will borrow money. Government will take a debt. Now, people might say that taking a debt is bad, right? But John Maynard Keynes says that what is the purpose of the government? Government is not here for profit. Government is here for saving the economy. So take this debt. Don't worry. Take this debt. Clear? Make sense? Yes. So this is what counter-cyclical policy is. And John Maynard Keynes says that if you'll take this debt now, right? If you'll take this debt now, you're scared. I know you're scared that what will happen in future, I'll have to pay off that debt. What will happen? So John Maynard Keynes says that in future, when the economy comes back to the boom phase, then you can raise taxes and reduce your spending, earn some money and pay off your debt. Earn some money and pay off your debt, right? So during boom, generally governments have a tendency of spending more and reducing taxes because there is money all around. So government thinks, let's spend because we have so much money, and let's reduce the taxes on the people because we have so much money. Keynes says, no, do the opposite. During boom phase, go counter. Increase taxes, reduce spending, so that you have enough money left when the recession comes again, so that you can reduce taxes and increase spending. This is what he meant by counter cyclical measures. Go counter to the cycle, because through that you'll stabilize the economy. Make sense? Now let me tell you one more thing. Okay, thing is that if government increases its spending and reduces its revenue, okay, in that example I said that the government spending was 200 and this revenue was just 50. Yes, this difference between the two is known as fiscal deficit. Okay, fiscal deficit, a deficit, and this deficit is coming from fiscal policy. This is known as a fiscal deficit. Okay, and this fiscal deficit is fulfilled by debt, borrowing. So John Maynard Keynes says that counter-cyclical policy is nothing, very simple. During recession, increase your fiscal deficit. Increase spending, reduce revenue. Okay, take debt. And during boom, well, do the opposite. Reduce your spending, increase your revenue, pay off that debt. Clear? If you'll pay off that debt, then you'll have enough room left for future recession. Okay, you'll have enough money for future recession, because in future, you'll have to increase your spending and reduce your revenue. So save some money now when you are in a boom phase. Make sense? Okay. So during recession, fiscal deficit increases. During boom, fiscal deficit declines. Debt declines. Make sense? Right? Now let's talk about this table. Counter-cyclical measures. So number one advantage of counter-cyclical measures, okay, is that during recession, we increase fiscal deficit. Okay, and this expansion in fiscal deficit is nothing but fiscal expansion. Okay, is nothing but fiscal expansion. Clear? So counter cyclical measure says that during recession, you go for fiscal expansion. What would happen? Fiscal expansion would boost growth. Okay, how would you go for fiscal expansion? Well, fiscal expansion means decrease taxes, increase spending. Because if you decrease taxes, increase spending, you are going for fiscal expansion. This would boost growth. This would definitely increase fiscal deficit and increase borrowings. Clear? Make sense? And John Maynard Keynes says that if inflation is very high, during boom phase, inflation generally increases because there is such high demand. Make sense? So John Maynard Keynes says that during boom phase, inflation is very high. At that moment, increase taxes, reduce spending. Okay, when you'll increase taxes, reduce spending, it would lower fiscal deficit, it would reduce your borrowings. Clear? And it would lower inflation. Why would it lower inflation? Well, very simple. If government increases taxes on people, then people have less money to spend, less aggregate demand, inflation comes down. If government is spending less on goods and services, less aggregate demand, inflation will come down, right? So John Maynard Keynes says that counter-cyclical measures have two purposes. One, to boost growth. Okay, to boost growth, you have to increase your fiscal deficit and increase borrowing. This policy is known as fiscal expansion. Increase in fiscal deficit is known as fiscal expansion. And when during a boom phase or a normal phase, when there is high inflation, well, increase your taxes, reduce your spending. This would have an added advantage of lowering your fiscal deficit and borrowings. Plus, it would lower inflation also because it lowers aggregate demand. This policy is known as fiscal consolidation. You have to remember these two terms. These are keywords. You have to use these words in your answers. These are technical words, by the way. Fiscal expansion and consolidation. Okay? And you have to understand their meaning also. So, what does John Maynard Keynes says? During recession, go for fiscal expansion. During normal times, go for fiscal consolidation. Very simple. Clear? Make sense? Okay. Now let's move forward. I hope you got this. During recession, fiscal expansion, increase fiscal deficit. Okay. During normal times, decrease fiscal deficit, fiscal consolidation, because that would also lower inflation and would also give you some money to use in future recession for fiscal expansion. Clear? Now let's talk about effects of fiscal expansion. What is fiscal expansion? Very simple. Fiscal deficit increases. How it increases? Well, you reduce your revenue and increase your expenditure. Okay. Now, what are the effects of fiscal expansion? Well, it boosts aggregate demand. Okay. It increases public investment. Because what do you mean by expenditure? Expenditure can be normal expenditure by the government buying goods and services. Expenditure can also be if government buys capital goods. That is also expenditure. And what are capital goods? If government spends on roads, bridges, electricity infrastructure, water infrastructure, right? All of this infrastructure spending is nothing but capital goods spending, because all these things are capital goods, right? And because they are capital goods, we can call them investment. So roads, bridges, electricity infrastructure, all of this thing is called investment because all these things are capital goods. Now, during fiscal expansion, government not only increases its spending on normal goods and services, which boosts aggregate demand, and government not only reduces taxes, which boosts aggregate demand, government also increases its expenditure on capital goods, which increases public investment. And what is the advantage of capital goods? Go back to the lecture of national income accounting. What was the added advantage of capital goods? Well, capital goods increase the capacity of your GDP. If there was one machine in your economy that produced 100 pence, your capacity was 100 pence. But now if you'll add one more machine, now your capacity of producing GDP is 200 pence, right? So investment or expenditure on capital goods increases your chances of increases your potential GDP. It makes your GDP larger. So fiscal expansion increases public investment, right? So public investment is added, aggregate demand gets boosted, we get out of recession phase. This is one of the advantage of fiscal expansion. But John Maynard Keynes says that use fiscal expansion only during downturn times when the economy is suffering. Because if you'll use fiscal expansion even during normal times, then what would happen? Then this boost in aggregate demand, already the demand was high, this boost in aggregate demand would increase inflation. So when the economy is going through recession, then do fiscal expansion. But during normal times, if you'll continue with fiscal expansion, this excess demand would lead to inflation. Plus, this excess public investment, okay? Because during normal times, if you will increase fiscal deficit by fiscal expansion, then that would mean more government borrowing. Okay? And when government borrows more, it crowds out private investment. So during recession time, all of this is fine. Fiscal expansion is fine. But during normal times, if you do fiscal expansion, it will cause inflation. And to fund that fiscal expansion, government would have to borrow more. And when government borrows more, it crowds out private investment. Now the question is, what is crowding out of private investment? We'll talk about this. Okay. Now to understand crowding out effect, you need to understand a few basic things. And I'll try to explain crowding out effect with a very simple example. You see, government does investment, and where does that money come from? Well, government borrows money. Okay. Private corporations also do some investment, and where does that money come from? Well, private corporations borrow money. Now, all these institutions, whether they are public institutions or private corporations, they borrow money from a bank, or let's say an NBFC. We have talked about NBFC, but for simplicity, let's say that these institutions borrow money from a bank. Now, banks have limited savings with themselves. Okay, banks have limited deposits with themselves. The amount of money that people have deposited in a bank, banks can make loans only out of those deposits, right? And those deposits are limited. Let's suppose the entire country of India has deposited 100 rupees with a bank. Okay. Now, let's suppose banks are also not doing fractional banking. You remember fractional reserve banking? Banks keep some things with themselves as reserves and then loan out the leftover amount. Yes, but let's suppose banks have the freedom to loan out this entire 100 rupees, which they have kept or which they have received in the form of deposits. Now, let's suppose in normal circumstances, government has run some fiscal deficit and it needs money from the bank. So government borrows 30 rupees from the bank. What amount is left with banks? 70 rupees. Banks loan out this 70 rupees to private corporations of the country. Very simple. But let's suppose government is following the policy of fiscal expansion. In fiscal expansion, government increases its fiscal deficit. By that, we mean government increases its spending, reduces its taxes. That means government has a lot of deficit. And where would the government fulfill that deficit from? Well, it needs to borrow. So because the government is running high fiscal deficit because of the policy of fiscal expansion, government's borrowings increase to, let's suppose, 60 rupees, from 30 to 60. Now, banks have 40 rupees left. Okay, banks have 40 rupees left to loan out to private corporations. Now, these private corporations demanded 70 rupees in loans because they had some investments to make. They wanted to make investments worth rupees 70 and they were demanding 70 rupees. But banks do not have 70 rupees to loan out to them. Banks only have 40 rupees. Therefore, private corporations are forced to make only 40 rupees worth of investment. And why did that happen? This happened because government increased its borrowings. Because the amount of savings or deposits that a bank has, well, they are limited. Okay? And if government takes a larger chunk out of those deposits, then private corporations have less money to borrow from. Okay? And therefore, they'll have to make less investments. Can I say, because of increased government borrowings, private corporations are crowded out? Private investment is crowded out. Yes or no? Yes, because government increases its borrowings, so private corporations or private investment has less money. So private investment is crowded out. Right? This is crowding out effect. When government increases its borrowings, private investment is crowded out. Yes? Makes sense? Now, this is a very layman way of explaining crowding out effect. I'll give you actual definition of crowding out effect. Okay? Though the basic idea is the same. Okay? But to make things simple, I gave this example. Okay? Within this example, the actual definition of crowding out effect is, I'll tell you. You know how interest rates are decided? Interest rates are decided based on demand and supply of money or supply of loans. Yes. So if government borrows more, 60 rupees, the money that is left with the bank is 40 rupees. But the demand for loans is 70 rupees. Yes. So demand for loans is high, supply is less. Don't you think interest rates on loans given to private corporations would increase? Yes. So interest rates would rise for private corporations. Loans would become expensive for private corporations. Yes. And because the interest cost of various loans would become expensive, many private corporations would opt out of taking a loan. They would postpone their investments because they think that loans are very expensive. This is what crowding out effect is. This is what crowding out effect is. When government borrows more due to expansionary fiscal policy, it leaves less money for private sector to borrow from. Thus, interest rates increase on loans and private sector is disincentivized from borrowing and private investment is crowded out. Okay? So, fiscal expansion has this big disadvantage. It crowds out private investment. And it is for this reason many economists say that fiscal expansion should never be followed. Okay? You see, I'll tell this to you. There are many economists in the world and they are divided into two groups. Okay? Some economists are called fiscal conservatives. These fiscal conservatives, these economists always say that fiscal expansion should never be followed. These people are so conservative that they say fiscal expansion should never be followed. Why it should never be followed? Well, it leads to inflation. It leads to crowding out of private investment. Yes? Now, who wants these things? Why should we do these things? Right? So, fiscal conservatives always say, okay, just a second. Yeah. Fiscal conservatives always say that we should never follow fiscal expansion because, well, it causes inflation, it leads to crowding out of private investment, it impedes, basically, it roadblocks private corporate activity, or it actually stops or puts restrictions on private economic activity. Therefore, you should always follow the path of fiscal consolidation. And these economists are very well known. They never favor fiscal expansion. Okay. Then there is this another category of economists who are called fiscal expansionists. As the name suggests, they say that fiscal expansion should be followed. Okay. In fact, they say that whenever growth is slowing down, you should follow fiscal expansion. Okay, fiscal expansion is a very good thing. Fiscal expansion has many advantages. We should follow fiscal expansion. Yes, during ultra inflationary times, we shouldn't follow fiscal expansion. But even during normal times or even during little slowdown times, fiscal expansion should be followed. These people are called fiscal expansionists. Okay, and there is this constant debate between these two sets of economists. Newspapers are generally filled, their articles are generally filled with debates between these two types of economists. Some economists are fiscal conservatives, some economists are fiscal expansionists. Now, the argument given by fiscal conservatives is that fiscal expansion has a lot of disadvantages. But the argument given by fiscal expansionists is that fiscal expansion has many advantages. Right? And these two people always fight. This fight is continuous. This fight has never been settled. This debate is continuous. Okay? Now, fiscal conservatives say that fiscal expansion is bad because it causes inflation, it causes crowding out of private investment. Then, in reply to these arguments given by fiscal conservatives, what do fiscal expansionists say? Well, fiscal expansionists say that fiscal expansion has a lot of advantages. Okay? Suppose economy is going through recession. So fiscal expansionists say that fiscal expansion has a lot of advantages. Suppose the economy is going through a recession. Okay. Now, during that time, if you increase fiscal deficit, okay, and fiscal deficit increase means you should reduce taxes that would boost aggregate demand and get us out of recession. Plus, your spending should also increase. And fiscal expansionists say that this spending shouldn't be targeted towards subsidies, salaries of government employees, welfare schemes. No. This spending should be targeted more towards capital expenditure, public investment. Okay? This should be targeted towards capital expenditure, public investment. So the increased spending that you're doing should be towards roads, bridges, electricity, infrastructure, and other types of infrastructure. Why? Because This expenditure would not only boost demand, because if government is making roads, it would naturally increase demand for cement, it would naturally increase demand for iron and steel, because iron and steel is used in manufacture of roads and bridges, right? So if government increases spending, it would not only boost aggregate demand, it would also create roads, bridges, which would increase the productive capacity of India's GDP. India's potential to produce goods and services would get increased. Potential GDP would increase. Right? Make sense? So whenever an economy is going through recession, you increase fiscal deficit. It doesn't matter that you have to take borrowings. It's okay. Right? You increase your fiscal deficit, you increase public investment, that is capital expenditure. Both these actions, reduction of taxes, increase capital expenditure or public investment, would boost aggregate demand. Spending on infrastructure projects increases aggregate demand, because these infrastructure projects are made up of certain goods and services. Their demand would increase, right? And the factories that are producing cement, iron, and steel, they would improve their economic activity. So it would boost aggregate demand. And when aggregate demand gets boosted, people have more money. When people have more money, they spend more. Now, private investors would increase their investment also. Because during recession, private investors were not increasing their investments, they were holding back on their investment. What is private investment? Suppose I have a factory, right? And I open another factory. In that another factory, I'll spend on plant, factory building, right? I'll spend on buying machines, right? So when I open another factory, I spend on plant and machinery. So when I open another factory, I am doing private investment. But the problem is, when the economy is going through a recessionary phase, there is no incentive for me to open another factory. Why? Because my existing factory is producing these pens, and these pens are not being sold in the market because people don't have money. Incomes have fallen, right? Demand has fallen. So why would I open another factory? But if tomorrow people's incomes rise, okay, demand rises, now there is incentive for me to open another factory. Clear? So fiscal expansionists say that during a recession phase, when you increase fiscal deficit, when you reduce taxes, when you increase public investment, aggregate demand gets boosted. When aggregate demand gets boosted, people have more money. Now there is incentive for a private corporation to open another factories, or incentive for private investment. So demand is back on track. Private investment is back on track. What is happening? During recession, consumption was down, investment was down, and let's not talk about net exports. Let's suppose that is also down. Okay. During recession, this is down, investment is down. So fiscal expansionists say that you increase this G, government expenditure, okay, government investment. This would give people more money, they would spend more, so consumption would increase, private investment would increase, and GDP will be back on track. So when you follow fiscal expansion, aggregate demand gets boosted, private investment gets boosted, economy is back on track. Okay, now remember this. You studied crowding out effect, and this example was cited by who? Fiscal conservatives. That increased fiscal deficit causes crowding out effect. But fiscal expansionists say that when there is a recession, private investors are as it is not investing because of lack of demand. So during recession, if government increases public investment, if government increases capital expenditure, then it boosts aggregate demand and it gives private investors investment incentive to invest, right? So in a way, public investment is crowding in private investment, crowding in. Okay, because during recession, private investment was as it is low, but because of government investment, okay, demands have increased, private investors have started to come in. So fiscal expansionists say that government investment not only crowds out during certain times, during recessionary phases, it also has an effect of crowding in of private investment, right? So fiscal expansion is not all that bad. If government increases its spending towards capital expenditure, it leads to crowding in effect. Okay? Crowding in of private investment. Make sense? I hope you got that. Clear? So, fiscal expansionists say that there is a crowding in effect also. Make sense? And fiscal conservatives say, well, during normal times also you do fiscal expansion that crowds out private investment. So, who is right? The debate is continuous. The debate is on. But you should be aware of these two facts: crowding out private investment, crowding in private investment. By the way, crowding in private investment is also referred to as pump priming. Okay? When the economy is going through a recession, government increases its spending very highly. Government increases its spending and getting the economy back on track. This is known as pump priming. Economy is back on track, pump priming, crowding in effect. Clear? Make sense? Yes? So, thing is that fiscal expansionists have a valid argument. Fiscal conservatives, they too have some arguments, right? They too have valid arguments. Who is right? Well, I'll answer that question. First, let's talk about the precise arguments presented by fiscal conservatives. Okay, you understand the arguments made by fiscal expansionists in this picture, right? Why fiscal expansion should be done? Well, it increases aggregate demand, incentive for private investment, economy is back on track, pump priming. Okay, these are the arguments presented by fiscal expansionists. What are the arguments presented by fiscal conservatives? Okay, yeah, just a second. Yeah. So, what are the arguments presented by fiscal conservatives? Okay, fiscal conservatives say that if you follow the path of fiscal consolidation, it gives you macroeconomic stability. And what do you mean by macroeconomic stability? Fiscal conservatives say that if you continuously follow the path of fiscal consolidation, it reduces debt. Okay? Yes, if you don't have fiscal deficit, you don't need to borrow. And if you don't need to borrow, your debt is reduced, right? And when you reduce your debt, your economy becomes more stable. Okay? So, fiscal consolidation has a very good advantage of macroeconomic stability. Clear? Then, fiscal conservatives say that fiscal consolidation also reduces inflation and it has less crowding out effect on private investment. So, there are three good advantages, and these are valid advantages of fiscal consolidation. In fact, fiscal conservatives say that fiscal expansion is really bad, and they give another reason for that. They say that you might think that pump priming helps. You might think that increasing fiscal deficit now would boost your economy. But the problem is, if you're increasing fiscal deficit now, you're increasing debt on yourself now. Now, this debt would have to be paid in future. Yes, will obviously have to be paid in future. Debt has to be paid, right? So someday in the future, I'm not saying now, someday in the future, you'll have to pay this extra debt which you have accumulated because of increased fiscal deficit to save the economy now. Now, when in future you'll have to pay this debt, where will that money come from? Then you will increase taxes. You will increase tax burden on the people. You will reduce your spending to have the money to pay for your debt obligations in future, right? Now, in future, when you'll raise taxes on people, when you'll reduce spending, don't you think you are putting extra burden on the future generation? Yes, because someday you'll have to pay this debt. So basically, for saving the economy or for growing the economy now, you are sacrificing economic growth in the future. Yes or no? Because in future, you'll have to pay this debt and you'll have to increase taxes and reduce spending, put burden on future generations. So why are you doing that? Okay, you cannot save yourself from increasing taxes. Okay, you might decrease taxes now, but to pay off this debt, you'll have to increase those taxes in future. So in a way, If you're following fiscal expansion, then you're making the economy macroeconomically unstable, okay? Or you'll make it unstable during the future times. Make sense? In a sense, for economic growth now, you are sacrificing economic growth of future. You are not thinking about future generation, right? Yes. So why do that? Why go for fiscal expansion? Go for other means. Think about other things. Don't go for fiscal expansion every time. Yes, if there is a very deep recession, then even fiscal conservatives say that you should follow fiscal expansion, but to a limited extent. But during normal slowdown of the economy, then you shouldn't go for fiscal expansion, because fiscal expansion puts burden on future economic growth, right? And it makes the economy unstable because of increased debt, right? Plus, if you will follow fiscal expansion during normal or little slowdown times, it increases inflation, causes crowding out effect. Yes. So the question is, what should you do? So what should be done? Who is right? Fiscal conservatives or fiscal expansionists? Who is correct? The arguments made by fiscal conservatives are also valid. The arguments made by fiscal expansionists are also valid. So who is correct? And it doesn't matter who is correct or who is wrong. What should we do? What should economic policymakers do? Well, here you should clearly follow John Maynard Keynes. Clearly follow him. What did he say? He said, be counter cyclical. Now you'll understand the word counter cyclical completely. He said, during normal times, follow fiscal consolidation. Okay? And during emergency situations, follow fiscal expansion. Okay? This is what counter cyclical is. Clear? Be counter cyclical. During normal times, fiscal consolidation, reduce your debt. During recession, very emergency like situations, fiscal expansion works. Okay? In fact, the mantra is that you should follow fiscal consolidation always. Just use fiscal expansion for emergency situations. Right? Because the thing is that if you are following fiscal expansion even during normal times, then debt over your government would be extremely high. It would be so high that when recession comes in the future, you won't be able to raise more money or borrow more money, because already you have so much debt. Okay? Already you have so much debt that taking more debt would become unsustainable for you. And now is the time for you to take debt. Recession is going on, right? So why are you doing this? Instead, follow fiscal consolidation during normal times, so that when emergency hits, when recession comes, you have enough ammunition with you to follow fiscal expansion. Because had you followed fiscal expansion during normal times, your debt would have already been unsustainable. Borrowing more would spiral out of control. Things would spiral out of control. Okay? So save yourself, follow fiscal consolidation, reduce your debt, okay, every time. So that when emergency comes, you can borrow more. This would make you more stable, more sustainable, and would also help your economy to manage these economic cycles. So John Maynard Keynes says that follow counter-cyclical policy in true sense of the word. Okay? Neither of them are completely right. Neither fiscal conservatives nor fiscal expansionists. It depends on the situation. But yes, follow fiscal conservatives during all times, follow fiscal expansionists during emergency situations. All right? This is what should be the mantra of fiscal policy. It should always be counter cyclical. And with this, we have understood the three major goals of fiscal policy. And I've told you because we have taken quite some time on this third goal. So this is the most important goal: stabilization of the economy by counter-cyclical means. And government utilizes fiscal policy for this purpose quite a lot. Okay, these purposes are also fulfilled. Okay, but this is very important. Economists try to look at goal number 3 of fiscal policy. All right. Now we are done with the concept of fiscal policy. The next topic of discussion would be the most important document of government's fiscal policy, and that is government budget. But we'll cover government budget tomorrow. Okay, like I said before, fiscal policy would be covered in various parts. So we will cover government budget in part 2, that is tomorrow, because I want to take things slow and steady. In fact, slow is not important for me, steady is important for me, because I want you to absorb all the information that you are getting through these lectures. Okay, they should be absorbed. Okay, and how would you absorb them? Just watching the lecture won't do the job. Okay, because just watching the lecture, you might understand everything right now, but you will quickly forget it. Okay, so let it absorb, think about it, revise it, solve MCQs, solve questions. Let it become a part of your muscle memory so that these concepts are natural for you. Okay, they become a part of your body, brain. Okay, then we'll cover government budget. This is a very simple thing. If you understood today's lecture, government budget is very simple for all of you. And the important terms after that would be very simple. They would be like a cakewalk. But absorb today's lecture. All right. Thank you.